everyone, and welcome to Mercer Capital's webinar, Charitable Gifts of Business Interests, Planning, Timing, and Valuation. Bryce Erickson and Joel Smyer are today's presenters. Bryce Erickson is a managing director and board member with Mercer Capital and has been valuing businesses since 1998. He has deep expertise in gift, estate, federal tax valuation services, and litigation support services. His extensive knowledge spans the oil and gas industry, professional sports, and a wide range of other industries and valuation issues. Joel Smyer is the founding president and general counsel of the National Christian Foundation of North Texas. Joel specializes in complex, asset-based charitable giving. In this role, he serves as a trusted advisor to families seeking to integrate generosity into their business exit, estate, and succession planning. You can learn more about their backgrounds and experience in the Resources tab of this webinar. Before we dive in, let's review a few housekeeping details. If you encounter any technical difficulties during the webinar, please notify us using the chat box. To ask our presenters questions, please enter them into the Q&A box. We will address questions at the end of the webinar. To confirm your attendance for CLE and CPE credit, you must respond to at least 5 of the poll questions that will pop up randomly during the webinar. In addition, there will be a short survey at the end of today's webinar. We want to hear from you, so please take a minute to complete that survey. Finally, don't forget to explore the Resources tab, where we've provided additional helpful materials. Now, without further ado, I'll turn things over to Bryce and Joel.
Well, welcome everybody. We are so grateful that you have decided to join Joel and I today. Joel and I have been talking about this, and this is something that for each of our aspects, I think, Joel, that we're passionate about, and really have seen a fair amount of our professional practices intersect in the area to where charitable giving as a strategy for clients of ours and clients, I would imagine, of many of the folks joining us today, see and intersect. And hopefully this webinar will help to uncomplicate some things and explain some things that will help everybody step away from this with a better sense of how they can serve their clients and have better tax advantaged aspects and just really just see an excellent situation for everybody going forward. So we're going to talk for a couple of things here. And I think hopefully if you signed up for this, you saw a lot of these learning objectives. But we're going to talk about, and really Joel's going to kick in, where scenarios and situations to where these types of situations come up. We're also going to talk a little bit about some of the risks and opportunities that describe this situations. I will jump in and talk about where appraisals come in and what that looks like and how those appraisals can be substantiated and reported well in the eyes of the IRS. And we can talk a little bit about valuation and how values are impacted depending on facts and circumstances, timing, liquidity issues, and things that impact donated values. And just see where a lot of these, the legal, the charitable, the valuation, and transaction aspects all sort of come together. And Joel, I know this is an area that I think in your career over time has really you've done more and more of this as things have gone along. Just one thing before we move on, as we said in the disclaimer, nothing here, just so you know, is we're actually giving formal legal advice and should not be construed as such. So with that out of the way, though, Joel, if you wouldn't mind just giving a little bit of a backdrop about your situation and where your role with NCF has sort of brought you to being a part of this.
Yeah, for sure. Thank you so much, Bryce. It's a privilege to be with you, talk with you, share a few thoughts. Yeah, we've been working this together a lot over the years, so I'm thankful that we have an opportunity to co-labor with this sort of education and information. So, real quick, just to understand who we are and what we do, NCF, the National Christian Foundation, was created in 1982. It, by definition, is a public foundation, but embedded in it is a specialized ministry that is built to assist high net worth Christians in their journey of giving. NCF was unique in that in 1984 got the first IRS letter ruling for what is known as a donor advised fund today. And in the 1990s, NCF really started to concentrate on charitable giving around non-cash assets. And that opportunities grew over the years to the place where we're able to take the message into many different metropolitan areas across the country. The North Texas Christian Foundation, or NCF North Texas, was founded in 2008. My background, I think you heard a little bit. I'm a lawyer. I was a litigator for about 15 years and then left to start up NCF North Texas in '08. And Bryce, we really, the folks that got behind our movement were, as you said, very passionate about the opportunities around non-cash giving. And that has certainly been the case over the years. Over on the right on this slide, you see a lot of the statistics for the National Christian Foundation, over 6+ billion in complex assets, these business assets over the last 40 something years. And then if you go to the next slide, you'll see our statistics here in the North Texas area since '08. We've had a little over 1 billion in as of the end of last year, but most importantly, 533 million, or about 48% of all of the contributions made were in the form of non-cash, closely held business assets. So it is for a thing we've been passionate about over the last 18 years. We've seen a lot, still enormous opportunity. The marketplace still does not know of the opportunity. And so I really appreciate the opportunity to share a few thoughts today.
Well, what's interesting on this, and this will sort of segue kind of how this matters with our backdrop. One of the data points that you and I have talked about that really surprised me is, and I'm skipping forward, is that there has been a lot of wealth and has had a disconnect with the amount of how giving has been structured versus how wealth is actually generated. And we'll get back to that there. But I just, when you mention that, it really does tap into, when you think of giving, for most people think about cutting a check, and that's not the only way that it can be done.
That's exactly right. That's exactly right. Yeah, so when we get into this notion of kind of like you have here, the charitable gifting opportunities around estate and transaction planning, when I think about that just generally, one of the things that really drives our advocacy for folks to become educated and informed is because of the great wealth transfer. And there's sort of a bad news, good news narrative that we're going to talk about. I want to start with the bad news. And this is especially speaking to the professional advisors, lawyers, accountants, wealth advisors. We're in a crunch with our clients. And the client and that crunch is first the great wealth transfer that is for sure coming. I heard about it a little bit back in '08 when I was leaving the courthouse, if you will, to hear about estate planning and the like. They were talking about the great wealth transfer. We are seeing it. We're seeing it. And so what it is we believe over the next through 2045, near 30 years, boomers and silent generation are going to transition over 84.4 trillion in assets. Now, more than the assets, that's something that the National Christian Foundation looks at because there's a charitable giving component to it. But there's some other interesting notes to make about the great wealth transfer that we can look at statistically. The Exit Planning Institute, a great resource, in a market study they did, found that over 75% of the owners today say they want to transition in the next 5 to 10 years. And those aren't just boomers and silent generation. Those are Xers and millennials.
Hmm.
Lots and lots of business owners saying we want to transition. That doesn't necessarily mean liquidity event. Increasingly more families are wanting to transition wealth, transfer it to the next generation, including operating businesses. But it's certainly an important note. And a McKinsey study that came out this spring is even more, I think, startling, and I would encourage everyone to give it a gander. And it is basically one of the things they opine is they anticipate there's going to be 9 million exits of small, lower to middle market firms, more lower to middle market valued size businesses over the next same period of time, 5 to 10 years. But they make a particular note in the McKinsey study at how broken the process is. The process of
Interesting.
actually transitioning is complicated, it's hard, it's not linear. And that is a headwind, not just for charitable giving, but also for transitioning wealth to the next generation or to a new buyer. So that's the bad news, right? It's like, woo, got to get it together. The good news, let's talk about the good news. The good news is that this concept of asset-based giving that we're going to talk about, the process of just thinking through the possibilities around asset-based giving and getting prepared to make a non-cash gift. The process itself is a great clarifier for lots of thinking around families, especially in the hard question areas, such as how much is enough for mom and dad? How much is enough for the kids? How much are we going to give away? So if someone is going to, and especially advisors leading their clients, going to step into thinking about charitable giving as really a mechanism that helps drive other giving, not only is it going to be helpful for the family, but there's also tax efficiency that goes along the way. All right, let's go to the next slide and let's kind of unpack what you're talking about there, Bryce. So this is
Yeah.
statistics we found from the IRS and the Treasury world. The reserve banks have this information readily at hand, and it is how is resources held, and especially comparing how they are transferred to charity. And the reality is that charity mostly receives cash, right? 75% in this last study of resources that go to nonprofits is in the form of cash, but non-cash being 25%. But the reality is the gross estate of these families is less than 10% sometimes is cash. The vast majority of wealth, that which is appreciating in value, low basis, high appreciation, is held privately. And therein lies this opportunity for strategic planning. Go to the next slide. And this kind of sets the stage of what we're talking about. It's like, whoa, well, charitable giving, Joel, that just means giving more. And that's not necessarily what we're talking about here.
Yeah.
What we're talking about is how can we maintain our lifestyle, maintain the way we want to live life, but begin to increase our overall giving by reducing taxation. And that is where non-cash assets are specialists at being assets that help. Hey, I'm not taking away cash from family. Instead, we're adding deduction power and tax efficiency when the donor advised fund, for lack of better terms, owns this asset. That is when we really start to begin to see that efficiency. Okay, let's go to the next one. And what I want to start doing here, Bryce, is breaking down. We're getting closer to coming up with a couple of case examples. But before we do that, it's really important that we as advisors, whether you're in the charitable side like me, or you are an estate planner, or you are a wealth advisor, or you are a lawyer, general business representing businesses, it's really important that we help these families begin to see where they are in life stages. We like to say we see 3 life stages in the journey of any one of these stewards. There's going to be when we're building wealth, 25 to early 40s. Then there's going to be these very wonderful, if you will, harvester years where mom and dad now can really do a lot with strategic planning around non-cash assets. In the 20s to 40s, we're building businesses, we're mainly taking care of kids. But something does happen that there is a flip where kids start to move out of the house, cost of living comes down, my wealth, my ordinary income is going up, my K1s are reporting a lot more income than are frankly necessary for lifestyle. And sometimes we're beginning to do the divesting and we're able to do some reinvesting. We're selling businesses. So these, it doesn't always have to be with the sale of a business, but in these years, there are particular opportunities to what we say to do is to front load future giving. I may be giving my 10% cash on a regular basis to my favorite charities, but in these harvester years, before I start to go into my fixed income years, I have opportunities because of these non-cash assets to begin to give portions of them at times that aren't going to go directly to my favorite charity museum or the opera, but it's the idea of we're going to front load our future giving. Mom and dad are going to take these assets, receive the charitable opportunity of tax savings when they can, when they are, and then we're going to have those assets available for future giving in our fixed income years, especially for our kids. All right, so let's go to the next slide.
Well, one of the
Yeah,
things that's interesting about this, Joel, as well, just from my chair, when I see it with my practice and clients in that the valuation realm, when you see businesses build, you see them follow a similar pattern. We call it sort of an S curve, to where they spend a lot of time working and building their businesses if they're assuming they're starting it from scratch, and you don't see a lot of the value creation is behind the scenes and isn't front and center in terms of a dollar number on the business. And then in that harvester phase, a lot of times you see an inflection point
yeah,
where these things start to come together, and a lot of small, compounding effects happen. Just as our investor advisor friends see that, right?
yeah.
They'll say in a portfolio theory, it's not necessarily how much you have, how much time is in the market is really a matter, and that's where things start really kicking in. So we see a lot of times the value of these businesses during this harvester phase. That's when they really start to show up to where you can have the types of magnitude to for the impact of that giving to really play out.
Precisely, because that makes total sense. Because what's also happening is depending upon how my taxation is happening and my basis, but traditionally what's happening is, my basis is going down, my appreciation is going up. And so boom, 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 I'm starting to now really appreciate, and this kind of goes to the need of business owners, how few actually know how much their business is worth.
Yeah.
How many
It- it-
times there's the back of the envelope country club? Well, it might be 4x. Well, we time and time again, the importance of an appraisal is sometimes in the years building up before transfer, it's a really great place to be able to find out where am I on my transferability and my intangibles and the things that go way beyond just what my balance sheet shows.
they know what they've put in, hard costs, but they're not sure what the value, where the soft costs of their
Bingo.
development over time has happened. You mentioned a couple of studies here. I'll flip us to the next slide, but you mentioned a couple of studies. One study that I'm aware of in the valuation world is there's a group called Ocean Tomo, which is a consulting firm that specializes in intellectual property and intangible assets, and they do a study on what within the S&P 500, what the mix is of assets in terms of physical assets and intangible assets. And over time, that has shifted from the 1960s. Currently, of the actual market value, when you see the market caps of these companies, the 92% of that value is ascribed to intangible asset of some form or fashion. And
Phew.
so most of that is appreciation of intangibles that grow over time
Yeah.
that don't have much, if any, of a cost basis for a
Yeah.
lot of these things. They're developed behind, like we say, behind the scenes. The market recognizes the value of it from a market value standpoint, but the cost basis is not there, and so you have these really big, for a lot of companies, really big built-in gains that
That's
are
right.
there.
That's right. Which is the magic for the charitable giving side because there's so much that can be done with that. Yeah, so this slide, this is a great diagram. And this is where we operate with the families we serve. We really want them to kind of see this as well as talk about it, because sometimes words are one thing. What do we really mean? And what we're wanting to encourage families to do is develop giving strategies. Earlier, the better. And we have all kinds of right strategies for preservation of capital, growth of wealth, but very, very few families we serve really have solid giving strategies. So that is a big part of what we want to encourage. What goes into a giving strategy? Well, there are three key pieces, all right? So in a giving strategy, we want to first of all have a means for contributing charitable capital. That is, we're going to come back, we're going to spend most of our time in that. Once I've made a gift to, right, what I consider to be the family's charitable giving platform. Notice I didn't say a tool. Practitioners, we run too fast to decide upon a tool. We shouldn't do that. We should operate out of the assumption that there could be multiple. I could literally be serving a family who's got a private foundation, a donor advised fund after a non-cash gift, and some sort of charitable remainder CRUT kind of a vehicle, right? It's part of a really solid foundation. To advise about, oh, you need this or that is to shortcut the entire thing, and frankly, is not holistic kind of thinking. So we want families to recognize, even though we're only one of the three, we are a donor advised fund provider. It's key that we grab hold of the other tools and utilize them. Okay, then the grant making strategy, that's a separate object and discussion for a different day. Let's go back to this family wealth bucket. And what we ask the family to do, and what we have here is basically an example of a typical family. We ask a family, everything you own goes inside your family wealth bucket, all of it. And typically, what we find is this kind of an allocation where there'll be 10 to 15% in cash, and typically the publicly traded is in the IRA 401k. But the big value is held in either the operating business and or commercial real estate and or other privately held investments that have great value but are not traded publicly. Okay. Okay, so Joel, you said that there's a way for me to start with charitable giving to make life a little easier for my overall planning, and I want to lay that out for you. So we always think of the first family here as being generation one, right? So mom and dad. And what we say is that there are three key stewardship questions that everybody of every faith is going to answer. Question number one, how much is enough for mom and dad? Question number two is how much do mom and dad want to press down to the next generations? And typically, question number three is how much are we going to give away? And oh, by the way, at the end of the life for the second to die. So we are estate planners. We love your estate plans. We love for them to have very well thought out, charitable remainder provisions where there's going to be bequests going to ideally a donor advised fund or a charitable remainder trust, whatever that might be. All that stuff at the end of life is all very necessary, but giving through an estate plan is the most inefficient way and frankly the most lost opportunity way we could do. Rather, what we want to talk about is the opportunity of saying, hey, if you're going to give away 10% of everything you got in that family wealth bucket on the last to die, why not begin to now mobilize those resources, the cash publicly traded and the privately held in this 10% bucket, begin to move them charitably into our charitable giving platform when it makes the most tax and business sense. With a charitable gift that goes out at an estate plan at the end, I can avoid estate taxes. That's a great way to avoid taxes, but it gives me no benefit during life. And so, what we want to talk about is mobilizing non cash assets during life to not only help with, frankly, our ability to give more, but also bring family together.
So Joel, I've heard a lot of folks think about this, and when we work with advisors in regards to this, clients, from what I hear and see, clients a lot of times think through in terms of their own goals and strategies and life goals, and the advisors are there to help them structure those, but also to look at their specialties, which are a lot of the folks on this webinar, which is legal entity, the tax aspects, and finding a way to, you're saying finding a way to marry those so that one tail doesn't wag the dog the other way, I guess.
Bingo. Bingo. Because I'll tell you this, the most common concern that I have, that I hear from the families that we serve is we just don't want to give the kids too much.
Mm,
We don't want, we're scared. We want to give them enough. We want to give them enough to not, not stay at home all day, but to start a business, to own a house. We just don't want to give them too much. So now for the practitioners, but also for the family, that makes the charitable giving bucket the true manager of the wealth and the ability now to really maximize it because we're mom and dad. What does that mean? We're really drilling down on not only really the how much is enough to pass on to the next generation, frees up getting that answered, frees up our ability to give away. But even if I don't know, hey, Joel, kids, I don't know, I really love them. If I just think, is there some percentage that if I was to die tomorrow that I would want to pass on in my estate? 10%? Okay, we don't have to solve for how much is enough today. We
mhm,
feel comfortable that 10% is yes, that is something I definitely would give away someday anyway.
mhm.
Now let's give it away strategically. Okay, next slide. I want to now, in our last two things, I want to, oh, go up, sorry, go back.
Yep.
Yep, go back. Yep.
Sorry, there we go.
There we go. Now let's go to the next slide. All right. So we're gonna now I'm gonna give two quick examples of non-cash asset-based giving. And listen, the easiest example is publicly traded stock, right? I take my Apple shares that are worth $100 and I have a $20 basis and I make a gift of that to my favorite charity or to my donor advised fund. I get the very important fair market value deduction, right? That's what we're looking for. But
Mhm.
with my Apple stock, I get my fair market value deduction of $100, but then my donor advised fund is going to sell that Apple stock, and what I actually have deposited to give away is 100. So I got the 100, I got a deduction for the 100, but all I paid was my 20. So it is the spread on the capital gains opportunity combined with the deduction. But how does that work with a business? Let's say that inside of this family wealth bucket, we've got a family with a $10 million business. And let's say that they are planning to sell it in the next year or two. And they plan to be charitable with 10%. And they're thinking, I want to write a check, sell this thing. I'm going to write a check for $1 million and I'm going to put it in my giving fund or I'm going to pass it out to all of my favorite charities. But I'm going to, in the year of the sale, get my $1 million deduction.
Yep.
The opportunity is for the family to say, okay, hey, what if instead of me writing a check after a sale, what if I were
After
to
it
give
closes.
LLC units of approximately the same amount before there's any kind of a sale? And now what's going to have, I have my opportunity, I get a double benefit. I'm going to get my fair market value deduction, but like with the Apple stock, except now it's with my business, which is highly, highly appreciated, very much low to no basis, I'm going to be able to avoid cap gains because my giving fund owns it essentially. Now, let me clarify here. No donor advised fund owns a partnership interest. So I'm speaking a little flippantly. Actually, what happens under the surface is we have an entity that holds privately held assets and an account. And when when it monetizes and distributions flow, it then goes into the liquid donor advised fund. But the tax effect is there. So I could save easily 2 to 250,000, just quick math, by me making a gift of partnership interest in advance of a potential liquidity event. That is what is we consider to be a double benefit kind of giving opportunity when I'm making a gift before an eventual sale.
Gotcha.
Let's talk about the second. We'll come back and we'll talk a little bit more about these kinds of transactions. But while we're talking about, okay, Joel, if that's a double benefit, could there be a triple benefit? And I'm going to land the plane on the triple
Three
benefit.
scoops of
Hold on,
ice
wait.
cream.
But, yep, hold on. Let me just do that real quick. Yeah. So, yes, next we'll talk about the triple benefit. Okay, in this case, we're talking about a family who we see happen quite a bit. Let's say that the doc that that mom and dad are both doctors and they have a medical practice and they have an opportunity to sell their medical practice. In today's it's amazing to me, but in today's private equity world, there's definitely a way for us as a National Christian Foundation or another donor advised fund, public charity to be involved in that. But a lot of times the complexity of licensing just says, yeah, I don't really want a donor advised fund provider, the public charity that's under the donor advised fund. I don't really want them to own any of my medical practice. So I'm going to transact that sale, but what I'm going to do now, I'm going to maybe, give some cash out of that. But what I'm especially going to do, this medical building that I own, that my wife and I bought several years ago, it's been great for us. We're still going to stay in our practice. We've got other doctors renting from us. We love giving. We're not selling this anytime soon. So the opportunity is for mom and dad to make a gift. And let's say it's of 10% of the commercial building. Let's say it's a limited partnership interest.
Mm-hmm.
They're the GPs. They've got limited partner. They're going to give us limited partnership ownership. They're going to get their 10% deduction, fair market value deduction that is then offsetting the gains of this very big year. So we have the most important first layer, first benefit of the deduction, helping offset gain. But number two, now my account, my non-liquid giving account, owns that real estate.
Mm-hmm.
If Dr. Smith and his spouse, if the Smiths own the real estate and it's hitting their 1040, they're reporting ordinary income by it. So if they want to be generous with 10% of the rental income, they can do so by getting a deduction for it.
Mm-hmm.
But if they get the deduction in the year they need it, and now they just have their giving fund, their non-liquid account holding that partnership interest, all of that income is allocated to their partnership or to their charitable giving account, not to them, and that is tax free as to the giving fund, assuming no debt. That can be a little bit of a headwind. So this can be years of this hold for this real estate, tremendous income to be able to be immediately gifted away. Most importantly, what's the third benefit? Well, if they sell that building, and that just repeats the first scenario, which is now that my giving fund or my account for giving already owns that limited partnership interest, I've got now highly appreciated. I'm avoiding the capital gains on the sale. I have even more to give away. Okay, that's any questions on that one, Bryce, as we're looking at that? What's different is this could be done without there ever being a sale on the horizon. And many
That's what I was going to
families,
ask. Because there's, I think you'd mentioned like there might be some assignment of income types of concerns that could be associated with that, and then of course what gets assigned in terms of what's tax free and what isn't.
yeah, so the good news is that the assignment of income doctrine does not apply to that whole, which we're going to unpack a little more, does not apply to when I'm making a gift of a real estate gift or interest, and I do not plan on selling the property, or at least not anytime soon. So we can avoid that. What happens then from a taxation standpoint is I own now my GP and whatever it is, the remaining 90% of the limited partnership interest. But on day one, my, if you will, my charitable account now owns the other 10%. And so as far as my K1 is concerned, right, I'm going to get my K1 from my GP and my 90% that my wife and I own together. But my giving account is getting the K1 for the other 10%, all of that allocation. And if there's no debt, they get all that tax free. That goes into my giving fund, and I'm able to now invest it further, or I can grant it out to my favorite charities.
Yep. Very, very good.
Okay, I'm landing the plane now. I want to just comment on tool talk and we're done. Next slide.
There we go. Yeah.
Okay. All right, so we talked about the importance of having the right platform for doing the charitable giving. I want to do a little bit of a drill down between a private foundation and a donor advised fund, or really what we're calling a public charity that can accept non-cash assets. Private foundations, we call the most public because they are truly entities that you're creating. You are one who creates it, is on the radar with the IRS as a disqualified person. We're filing our 990 PF at the end of the year, and 100% of our grant making as well as our assets is publicly known. Um, Private foundations are fabulous when families are wanting to do nonprofit charity work and there's not a charity to make a grant to. So,
Mhm.
like families that have little kids or older kids that are wanting to do something on their own, that can be a tremendous opportunity. But the challenge with a private foundation is the rules around non-cash giving for purposes of this discussion. And there are two that are most significant. One of them is private foundations have lots of self-dealing rules and other kind of regulations that manage, hey, if you're a donor and a disqualified person making a donation to a private foundation that you control, lots of rules. One of the biggest headwinds is in the charitable giving world is that if I tried to make, and even if I could make a gift of an asset, a non-cash asset to my private foundation, my deduction is limited to basis.
Hmm.
That won't work. I need a public charity where my fair market value deduction comes in, which is the reason, of course, talking to you about appraisals, because that's where the economics work.
Well, yeah, that is, again, with such a disconnect, especially in these days, to where cost basis and fair market value in many, in many of these scenarios, not all, has such a large gap. That's where, at least from a tax perspective, the opportunity presents itself. Um, yeah, and what's it's sort of transitioning into that, valuations, which we've done, of which in my practice over the years we've seen this as well, is um, uh, you know they come into the picture. They come into the picture in terms of potentially for the liquidity event and for the harvesting phase. They really play out a lot of areas. And although the purpose of today's webinar is to really zero in on the charitable giving in terms of getting there, I thought I would just sort of kick in terms of like there's a lot of things that lay out in terms of why a valuation may or may not be needed. And what I've got here, just as a lead in, um, is that through the course of potential donors' lives and through their business lives, they may or may not, but there may be a lot of reasons why they might have actually gotten a valuation. Certainly, on the transaction, if this sale, that the hypothetical sale that we were talking about, earlier for someone's business during a harvesting phase, they may just get it for just negotiating and selling or pricing the business. They may do it in terms of deal structure. There's different ways that corporate planning. Sometimes they get valuations for as far as transitioning shareholders, not only just to the family, but maybe to future employees, whether that be through an ESOP or whether that be just shares for the company. And of course, as we say, charitable giving. A lot of our advisors are familiar, and I work with a lot of clients for estate plans, for putting parts of these businesses into family limited partnerships, in selling to trusts, giving to trusts, so on and so forth. And valuations are required certainly in those scenarios. And then, of course, there's some unpleasant scenarios as well, whether it be a buy-sell situation between shareholders, divorces, so on and so forth. So there's a number of areas to where to where these valuations come into play. And like I said, we're just talking primarily on up here on this charitable gifting realm. Another thing that we have here that won't spend too much time on this slide here is just um, you can sell part of a business. And Joe, I think some of this charitable giving, these scenarios, it's not even a total sale of the business. Sometimes it's an installment or a piecemeal. And
For
so it's not
sure.
an all or nothing scenario.
For sure. For sure. Yeah, that's exactly right. I'm going to do a little bit, but I'm going to still stay in my business. I've got somebody coming in and buying a piece of it, taking a little off the table. That's correct. Every step of the way, there's opportunity.
So there's a lot of as this great wealth transfer happens, it's not always in an all or nothing scenario, and this is where it comes to the planners and to our friends on this call who are helping these clients along the way and navigating these as they move through these lives. But digging in more specifically onto the charitable giving, for these complex assets, as you mentioned, Joel, valuations and getting these double and triple benefits in particular, from a tax standpoint, if you're going to be giving complex assets, the valuation is a more complicated endeavor than it would be for something straightforward as a Apple stock, of which the price per share is notated on exchange and it's updated, with sometimes for super liquid businesses within seconds, and versus a closely held business that doesn't have is traded on a publicly traded exchange, and the only time that what the business is worth is either when you sell it or you can get an opinion for someone like myself. When it comes to donated property and charitable giving purposes, there's some other scenarios under the tax code that are specific to other scenarios. So today we're really going to be talking about the charitable giving aspect of it. IRS publication 561 is probably the most commonly cited realm that covers this. And I'm just pointing out a few things. It's I've got a link to it here. Folks, anybody, you can easily find it, but if any of you want to get a link or have me send it to you, Joel and I would be happy to send it here after the webinar. But a couple of points as it pertains to this. One is that gifts over $5,000 require appraisals. Joel, I for most of my clients, that number tends to be a lot higher, simply just because one of the factors to consider is that the transaction costs and the advisory costs that go into some of these gifts is a meaningful thing, and so the gift has to be of a certain magnitude, I think, for it to make sense for a lot of these donors, I would think.
Great point. And that's what we want to do. Whoever you're talking to, they need to be able to model this. We need to be able to model out putting in the various inputs. What do we expect the economics to be? We typically see value at about like Joel, where does it start to make sense? I'll just say right at about 300,000. At about 300,000, if you're trying to think of what's the size of a non-cash asset to really start to see some of the eye-popping numbers, it's about there. Can I do it for less? Yes, but now what's the tax benefit? Because out of the tax benefit is going to come the appraisal cost and those other incidentals, plus just the friction cost of doing it all. We want to make sure there's some economics.
Yep. So when it comes to these closely held business interests, which will focus mostly on an operating business, but there's as Joel, you mentioned earlier, some of these real estate entities are held in entities, right?
Yes.
And so it's through a business, but they require what the service defines as a qualified appraisal from a quote qualified appraiser, and those are defined terms which I'll touch on here in a second. But basically what the service here, the IRS acknowledges, is that this is a complicated effort to value an interest in a closely held business, and so you have a lot of things to consider. When we do evaluation, we step into the shoes of a hypothetical buyer and seller, and although we don't go through the entire universe of due diligence that would be involved for an actual transaction, we touch on the things that are pertinent to value, and that's an invasive exercise. We look through the books and records, we talk to management, we review, we do research on external market factors, industry factors, so on and so forth. And so there's a lot of relevant factors. There's for many on this call who are familiar with valuation, there's the IRS has laid out in Revenue Ruling 59-60 what those high-level factors are, and it's a well-known thing. The other is that there is appraisers are actually expected to actually sign a report. This is the one area that where appraisers actually take very real risk
You
because
bet.
we sign the tax returns to attest to the fair market value of that donation for those tax benefits. Um, just something else to note, like I said, where we're talking about the complex, not cash gifts, people can donate and gift all sorts of things. Joel, I'm sure you've seen this as well, whether it be art, whether it be vehicles or cars, some donors are into classic cars or airplanes even. There's lots of different types of aspects and assets, and the IRS publication 561 touches on some what they expect or want to see for various of those. We're going to be zeroing in on the closely held business element here.
It's good.
So, and I'm sure you may have a story or two about some interesting assets that have been contemplated, donated over the years. But
Yeah, Ben.
in the interest of time, we'll
Pass on that. Yes.
we'll pass on that. So, a little bit about qualified appraisers. There's some standards. One, it has to be done under accepted appraisal standards. The most universal, the highest level is known as the Uniform Standards of Professional Appraisal Practice, USPAP for short. It needs to follow a professional framework, and so just having something saying, hey, I think it's worth this because I'm a smart person or because I said so isn't sufficient for the service. There's a certain amount of data and disclosure that needs to be required, and then there's some timing and signature issues. Joel, I'd be interested to say there, but signed and dated no earlier than 6 days before the contribution is formally made, and of course you can't do it any later than the actual tax return date itself, unless you're going to extend it.
Yeah.
I guess including extensions here as I'm reading there.
Yeah, and a couple of notes on that as you're saying that. One is on the qualified appraiser. I gave the example of real estate earlier, right? We talked about the doctors and they have their practices they out of this commercial building. One of the big mistakes that we have seen, and the IRS will be all over it, is for somebody to make a gift of real estate, them get the appraisal of the real estate, but they're not giving fee simple. They're giving partnership interest. So
Mhm.
it is a colossal mistake for a family who's going to make getting to the qualified appraiser. It's step one, appraise the dirt or appraise the building. But then step two is you've got to have a true business appraisal of the wrapper, because
Yep.
what is being gifted to charity is not title or a percentage of title. It is that limited partnership interest.
Yeah,
So
that's
that is a
exactly
really
right.
important point.
Understanding exactly what's being gifted, because as I mean, you know better than I do, but the legal ramifications of an entity, equity interest in an entity is a different thing than fee simple title, and the valuation is impacted separately accordingly.
That's right.
So moving on, qualified appraisers, what are they? Well, I think generally for most folks, an appraiser that has recognized qualifications after their name, I have a couple of that I personally think are the best, but there are others that are recognized out there. There is some minimum education requirements that someone without actual credentials can have. But I think the key is that they also have to have at least 2 years of experience for which they are paid. So having somebody who's particularly knowledgeable is great, but they have to be paid by third parties to do appraisals as from the IRS's vantage point. And of course, you can't be you can't have what they call a prohibited relationship. It can't be the donor themselves, a donee themselves, or a party to those to the transaction itself. Independence is really important alongside just not only the credentialing when it comes to that. Um, One thing, I don't think we're going to spend a lot of time on this just as we move on, but there's a particular case out here that I think is pretty well known. Joel, you're familiar with the Hoensheid or Hoensheid. I'm not sure
Yeah.
how it's best pronounced.
Yeah, I don't either. I call it
But
Hoensheid, but yeah.
there has been situations to where valuations and appraisals along with the gift have become at issue.
Yep.
And I think the takeaway from it is unfortunately, as I just described, the qualified appraisal and the qualified appraiser aspects, according to the case, were not met. And we had someone who I think was very smart, very intelligent, and may not have may have had a reasonable basis for what the opinion was, but it just did not meet the substantial compliance that the court was looking for.
Yep. This is a case where we have a do-it-yourselfer gone awry. And that do-it-yourselfer thought he could be the guy that would do it himself in terms of the appraisal. And we saw what happened there. And I see this a lot. We see people are like, well, how much do especially in real estate. Do I really need to get a business plan? Yes, you have to. I don't care. You can't have the guy that does the appraisal of your plot be the guy that is amending and applying that to the Form 8283. We have to have a qualified appraiser. So this was a guy who's trying to do it on his own there. And then there's another thing that impacts a doctrine called the prearranged sale.
Mm.
And what we're concerned about with a gift of an asset before a liquidity event is that the donor must complete that gift and make a gift to charity of that capital asset really before there is a binding obligation to sell.
Yeah.
And what we had factually in the Hoensheid case was a donor who was literally, the evidence was in his emails, my wife and I want to make the gift, but we want to wait till the last minute. We want to wait until we are sure that the deal is coming together. And that is exactly what the assignment of income, prearranged sale, assignment of income doctrine is. It's that, hey, listen, business owner, you really didn't intend to give charity a capital asset. You intended to give them an income stream.
Hmm.
So that means that for these players, these folks that really can get these kinds of deductions is because they fully understand they are making a gift of that business interest to that public charity, that public foundation. And it is in advance of there being a liquidity event. You and I will talk about LOIs later, but I just
Yep.
wanted to get that out there.
Yep. So, but moving on that though I'll talk a little bit of here about what valuation, what the fundamentals look like as well. We're talking about business valuation for closely held stuff. We're talking about putting a valuation of a business, whether it be ownership interest. It can be a security, it can be an intangible asset. Most of that thing, I think the majority of what we're looking here is would be zeroing in on as the business ownership interest, whether that be an LLC interest, a C Corp interest, an S Corp interest, or a partnership interest of some kind. And that can vary by state and entities, but broadly speaking, that's what we're talking about is an equity interest in a business or an operating business for the most part itself.
That's right.
How do you go about that? Well, traditionally, business valuation, very similar actually to real estate appraisal, is that broadly speaking, there are three main vantage points that you can look to ascribe value. There's an asset approach to where you're looking at it's really more of a true balance sheet aspect. For most operating businesses we're talking about, that tends to be the least considered because, as we've been saying here, the vast majority of values are intangible and they don't show up on a balance sheet from a cost basis. And so it's hard to ascribe value. Just because the book value of your business is X doesn't mean, is $100 a share, doesn't mean that the fair market value of your equity is going to be $100 a share. It may be many multiples of that or less than that, but in and of itself, that's not the case. Income approach, we're talking about income, right? Some sort of economic benefit, usually defined in cash flow or earnings or net income, and there's a lot of metrics that you can see to do that. But basically, converting those anticipated future cash flows into an amount, and then the market approach. You're just comparing similar or guideline business or business ownership interest to benchmark to see how much what those trade for, which could be a proxy for what your business may or may not trade for. And so those are the three main ways that we look at a business in terms of valuation. How that plays itself out, what is interesting, and one of the things that I enjoy about what I do is that looks differently for all sorts of different businesses. What I've got here for this situation is that different methodologies that play out in different situations. So for a manufacturing or a service business, Most times income or market type methods tend to play out. But for a high growth business, for folks in the tech sector, for example, a lot of times, you've got a fast growing business. Maybe sometimes it's growing so fast, you really, the market ascribes to something a growth metric as opposed to necessarily an income. And so anticipation of where your business is headed, and people will price and bake that into that now. Um, um, One of my favorite specialties, oil and gas and royalty interests. Those are done through a hybrid mix. But what's interesting from a valuation standpoint is if you're valuing an interest or a mineral or royalty interest in a well, you've got a cash flow stream that tends to decline because the well, the well might be
Right.
producing 1,000 barrels a day today, but tomorrow it could be producing 900 barrels or something less. And so it's actually a declining cash flow stream, which makes it kind of interesting. There's a lot of geological and reserve metrics, how much you actually have in the ground versus how much it's producing. And I think even from Joel, we've talked from an assignment of income from a tax standpoint. You didn't touch on this earlier, but I think oil and gas also falls into some specialty rules there.
For sure. That is considered to be passive. So if you look at this list, this is excellent. I think it's important if you're thinking about what do I want to do? What is the nature of my charitable gift in the hands of charity? There's going to be those assets that are treated as passive income assets to charity, and those that are active trade or business where my LLC interest in my operating business can be generating UBIT, unrealized business income taxation, unbeknownst to me. And so that's okay. Most of us are structured to be able to take UBIT. But yeah, royalty interests are passive. A couple of other things that I was thinking about as you were rolling that out. Profits interest. I may have an equity position in my dealership, but I also may have a profits interest in it. And those profits interests, especially with partnerships, can be extremely valuable, especially in the waterfall provisions when a business sells. Notes and loans, and those are obviously valued differently, but loans can also be a valuable non-cash asset that, like you're talking about, is like in oil and gas. It depletes down, it
Yep.
depreciates down. But all of those have the aspect of is it active? If it is, we can still be of tremendous value. But when does it make sense for us to find those passive income assets that are really helpful for charitable giving and make us get more to
And
charities
from a
we want?
valuation standpoint, for each of these, this kind of goes back to the credentialing stuff, but these are not necessarily easy to value. They're not a one size fit all. And so, working with from a valuation standpoint, working with an appraiser who really knows what they're doing in these spots. You can't just hire anybody, somebody who knows what they're going. And just a personal thing, one of my fun. I wish we could dive into this, but one of my fun areas that I've loved working with over the years is pro sports and with
Mm.
people who own interests in teams and leagues. The Seattle Seahawks just recently sold for Paul Allen's estate, a multi-billionaire estate. And if you read out there, they're actually going to be giving a lot of that the estate, the proceeds to charity. So there is a charitable gift. Now, based upon my experience over the years with actual ownership in teams and leagues, you can have a ownership for a charity or for a league team, but it's very cumbersome. And so make sure you've got the right advisors because it is not something very easily done. And you have to have team approval. You have to have league approval. It's interesting, but there's lots of different ways that you can do it. But the valuation is, really changes, and you have to have somebody, it's just not a one size fit all exercise.
That's good.
So speaking of these interests, and I will move quickly here, but what's actually being gifted? And we use the example of 10%. 10% that you were talking about, Jolie, it's typically a minority interest, unless perhaps you have super voting shares. Maybe you have a controlling a GP interest. That could be a different scenario. But most of the time, 10% interest is not have the prerogative of control. So in and of itself, it's worth less than what the business would be otherwise worth pro rata if it were to exit. And so for a lot of donors, that's something that's not the best thing that they would prefer. because you'd rather say, hey, if my business is worth $10 million and I give 10% away, isn't that worth $1 million?
Mm,
And the answer a lot of times with these equity interests is no, it really isn't, because what you're actually gifting is not the entire $10 million business. You're gifting that 10% interest, and the valuation has to be to follow that accordingly about what's actually being transacted.
that's right.
And so just got a little chart here that just follows that logic that, hey, if you give, and then somebody, Joel, and you may have seen this, if you're somebody particularly generous and you want to give a controlling interest, that can be done. But most of the time, that's not what we see in practice most often.
That's a great point. And let's talk about control. What the charity is going to want to receive as much as they can is non-voting. So a lot of times we'll even ask if we can build it. Like if we have a family, it's like we really want to give north of 50%. What we're looking for is, well, could we maybe have set up a different side, the shares differently? Could it be we have voting in Class A and what you give is Class B, because we do not want to control. And that's helpful. No, I don't
Yeah.
think any donor advised fund provider would, but certainly NCF does not want to be in the control seat. So we're trying to, hey, make sure that the steward is always the one calling the shots. And as much as possible, we are just passive owners, non-voting if possible. If we have to vote, we will, but we do not want to vote majority. So we would, if it was the family saying, yep, nope, we want to give you 75% and all the control, we'd be saying we got to restructure because we just
Yep.
can't take that kind of control.
And within that control, we've got our founder Chris Mercer at Mercer Capital is famous for putting this together. But you're giving away a lot of times to where the value on an exit for whether a control or a strategic sale, it's just not going to be on a dollar for dollar basis. And so the valuation's got to account for that. And that goes, I think you talk into the modeling and understanding beforehand
Yes.
there. Now, there are some things that I see a lot of times, because if you're planning for a transaction and you've got a potential sale, there is a connection to where the closer you are, relatively speaking, to an exit liquidity event, the value gets a lot closer to what the exit value would be. So there's not that much of a difference. And this is where letters of intent come into play. A lot of, Joel, I've seen this for valuation. I've seen clients to say, hey, look, we have a non-binding transaction coming up. We're in an auction process, or we have a letter of intent out there. Does that letter of intent can't we just represent that as the value? Do you need an
Mm,
appraisal with just an LOI? We've got this LOI. What else do you need? Kind of thing.
yeah. Yeah.
Um,
Yeah.
and I would just say from my chair, when that gets presented to me, I'd say that's terrific and that's helpful. And I think it's directional, but an LOI is just that, an LOI. It's intent, it's not binding, and doesn't dictate fair market value. And I've got a list to here some things that, like, there's a lot of things, deals, for those that are in the space, that they know deals are very organic things.
Hmm.
And a lot of things can happen, and there are risks that are ascribed to that, to where if you were honestly going to trade this thing before the deal goes down, you would price it accordingly. And a lot of times that would be less than what the actual exit price would be,
Yep.
because of those risks that you're taking in there.
Yep.
Whether it be closing risk, timing risk, whether a deal can get financed or not from the buy side, due diligence risks that come in, and audit risks. Breakup fees. There's all, just the two owners get together, and as they meet more, they realize it may not be a fit. There's just things that can happen to where the LOI alone can't be a direct representation of fair market value.
That's right. Especially because the law is that the appraiser has to decide what's the fair market value of the gift on the date of the gift,
That's right.
not the sale, right? So the sale thing is happening, but the law is what's the fair market value on the date of the gift?
But kind of back to those, when done right, this is just, as you're talking about these double benefits, when you do this thing in terms of these gifts, you can have the same gifts to where if you avoid the capital gains by doing it before the timing is, you really, this is just a visual here of kind of what those benefits can look like before or after. I mean, there's a benefit both ways,
Yeah.
but this is, um,
Yeah.
for that. So just moving on, I know we want to be mindful of time here, and we want to close here. One example, I just want to do a compare and contrast because a lot of our advisors may see valuations in the context of a gift and estate scenario versus a charitable giving, and they would say, well, is the appraiser just making something up or doing something different? And the reality is we're not. And this just shows the same interest in the same company under two different scenarios. Again, if you have a charitable gifting and you've got an LOI and you might be selling in the next 2 to 3 months or more, for example, you might have a buyback option or a put option associated with that gift. Joel, I know NCF has a lot of times their gifts has a buyback clause that increases liquidity. You can have discounts that tend to be relatively small if you're on the precipice, potentially close to the sale. As I said, those risks do exist, and so it's not a one-for-one thing most often. But the fair market value per share gets a lot closer to the pro rata control value of the share. Whereas in a gift scenario to where maybe somebody is looking down the road further, your kids are in grade school or high school, and things aren't going to happen for a while, but you're planning now. You might have years or decades till an liquidity event might happen. You're not paying dividends. There is no buyback clause to where somebody could where somebody could purchase that on a contractual basis. And that's where a lot of times you have these, the value is affected by that, and the discounts, of which I'm not the biggest fan of the term because it's just a reflection of value, frankly, in a truth sense. But you can see on a per share basis, the same interest is valued very differently under that different scenario.
Mm, mm.
So as we sort of wind down here, Joel, and I know we've got some questions I think we want to be getting to quickly, but for the folks who are watching here, what are some things I think that we can do to make sure that as you put these things together, that it can be done the most effectively and efficiently way that you were talking about earlier?
Yeah, yeah. Yeah, and the opportunity, I think, when we're looking at this, and one thing I want to mention is that sweet window of time and the LOI, right? I think I am going to sell my business. We actually have a non-binding letter of intent. Hey, do I have to make a gift before I sign the non-binding LOI? The answer is no. We can move into that sweet spot period that Bryce Erickson is referring to of when, hey, this is actually high value. But we can then make sure that we make that gift before we would enter into waters where there is a prearranged sale. And that is definitely where I'm going to need to kind of start to get my evaluation process going. And Bryce, I have a quick question for you. When you're talking to a family that we're serving and they're thinking about, where they are on what the possible valuation could be, there is a difference between talking to you and getting an understanding about what the discounts can be, and then also having the full-blown report that actually goes with the 1040 a year later after the sale.
Absolutely. It's, you don't, we can't get our opinion until we've actually done the work in terms of doing the work required for a qualified appraisal. And things can change, and facts and circumstances in terms of understanding can change. And so, our reports a lot of times are dozens and dozens of pages, sometimes in the hundreds of pages, depending on the client. And there's a lot of work that goes into documenting that properly so that it meets not only so it gives confidence to the ultimate opinion that we have, but it also meets the IRS standards. And there's a journey between those two spots.
Yeah. Yeah. So while we don't have to have your full appraisal done in order to make the gift, connecting with the appraiser during that process is huge for being able to unpack what it looks like, and you to frankly give some guidance around the process itself.
We can absolutely do that. Yeah, we obviously, without doing our work, we can't give a formal opinion, but we can give some scenarios to kind of give you at least a ballpark or a neighborhood of kind of where that modeling might be ahead of time as the advisors and the planners are working with your donors to see whether or not these deals make sense or how it fits within the overall plan.
That's right. And that just helps with the whole transaction timing.
Well, and to kind of wind this down, and we want to be mindful of time here for the audience is what are some pitfalls and some mistakes that folks can make? We want to know, hey, here's some wise things to do, but what are some things and I think we've touched on a lot of these, frankly, as we look down here, according to here, but what are some things here that can be some real tripwires and pitfalls?
Yeah, I think that treating a non-binding LOI as a risk-free without careful analysis, I mean, we do need to understand what is that letter of intent. It certainly doesn't dictate what the appraisal price is. That is, or the appraised value is. That is, it's basically the rules of engagement between the seller and a prospective buyer. And the key for this timing, what we like to say is that I'm going to make that gift during the LOI time period while I have an understanding of what that value is going to be on the day of the gift relative to the potential sale that could happen. But I'm making that gift and I can actually note two or three ways for the deal to fall apart. I like to call that the sweaty palm moment that I'm making the gift. It's during the LOI, but I can easily identify all the reasons why this thing may fall apart, thereby revealing what my heart's intent was from the very beginning, which is to make this non-cash gift to this public foundation for my charitable objectives. And as long as we
Well,
can do that, it's a key thing.
Well, and that just ties back to what we were saying earlier. That sweaty palm moment is the reason why the price isn't 100 cents on the dollar. It's a
Bingo.
contributor, right? It's something less than that because you do have sweaty palms.
That's right. That's right.
Um,
And it isn't a closed deal and it hasn't finalized yet. Otherwise, we'd be into what the Hoensheid situation was, which is the assignment of income doctrine, right?
yep.
These are the safe waters that you and I are talking about that are not cloudy, that are clear when we can be clear about, yes, we know we're having that sweaty palm moment.
I think probably the one thing I would pull out, I mean, that we could talk about all of these, but the one thing here is I think one of the things I see from the valuation chair is that last one is that a lot of advisors, spend a lot of their world in sort of this estate planning world and mindset. And when it comes to charitable giving, assuming that the same mindset or approach applies. And again, as I meant there in the compare and contrast, it may apply depending on the facts and circumstances and maybe restrictions, etc. But you don't automatically assume that the value is 60 or 70 cents on the dollar, relatively speaking, to control value.
Yeah.
But if like you might be in that type of scenario whereas you're moving towards a potential liquidity event, and that minority interest might be exiting pro rata with its control shares and therefore be worth a lot more relative to the control.
That's right. That's right. And actually, kind of related to that, but a little side is the charity that we're making the gift to. So it's going to be far stronger for these families to make gifts to a public foundation rather than trying to give any kind of an operating interest to an end user charity. They're not sophisticated. They don't know how to receive them, manage them. That's what's so beautiful about the public foundation donor advised fund pipeline. It is allows us to bring the business sophistication, NCF, Fidelity, Vanguard, Schwab, bring the business sophistication to be able to receive the gift, but protect that charity, frankly, from a lot of the cumbersome side of it. We can become a sophisticated user on behalf of the charity.
Well, this has been a fun going here, but I want to be mindful of time here. That's all we have from a slide standpoint. But Joel, I do think we've got a few questions in.
Great.
So perhaps we can take a few moments here to answer a couple of questions. And for those that we don't get to, we will, Joel and I will endeavor to get back to you shortly on whatever we can't get to. But one question that we have here is when must someone making a charitable gift of a business obtain their appraisal report?
Yep. Yeah, so that's actually one of the helpful features about that, because one of the things that I get a lot is, do I have to have an appraisal done before I make a gift? And that answer is no. I want you to talk to Bryce Erickson before you make a gift, and you need to beginning to work on your appraisal. But what the law says is that the appraisal supports the form, I believe it's 8283, that then attaches to the taxpayer's tax return for the tax year in which they want to claim the deduction. So you don't have to have a full appraisal done before you make a non-cash gift. You have to have the full appraisal done by the time in which you file your tax return and claim your deduction with the Form 8283.
Yep. Yeah, I think that's helpful. And again, as I said, we had earlier in there, about just the range, right? No more than 60 days before, and that when you apply in terms of, in that window of time, just from a structural
Good
standpoint.
practice standpoint.
Yeah.
Yeah.
All right, we got a couple, just to be mindful of time, a couple more here. Here's a question. Is there anything that can be done with giving closely held business interest that has restrictions on transfer clauses in its entity documents?
Yep. Every one of them is going to have restrictions on transfer to third parties, including charity. What happens is two things. One, we're trying to get only non-voting interests. So most important to partners and others in the mix is voting control stays whenever we can have it in the hands of the steward. They're just like in estate planning, giving a beneficial interest away. That's kind of like, the number one thread there. And then what was the second part of that question? It was,
Is there anything that can be done with giving those interests that has
yeah.
those types of?
And then the other side of it is all day long we can create the consents, right? And that's typically what happens is business owners and others will put together and agree to the kinds of consents necessary for a public charity to be this kind of a passive owner. So we see it all the time and we work with it all the time. It's nothing to be scared of.
Yeah, and just to answer the question from my chair, thank you for the question. I would say what we see is that the restriction on transfer in and of themselves, all else being equal, does lower values, right? Because it makes it you have a narrower market that you can access, and so that makes liquidity harder, and therefore tends to bring the value down. But one of the things that we can be done is, as you said, either consents, but we also see a lot of times is some folks can do, and this is, I think, where planning comes in, to where the gift itself can have put options or liquidity clauses that can counterbalance some of those aspects that can essentially create a liquidity, assuming that the buyer has the ability to meet those obligations, but that can come in and also can potentially impact value when you have something, for example, a put option associated with the gift.
That's right. A put that favors the charity.
Yep.
Right. The gift from the family has to be unconditional. There cannot be any strings attached. But that gift agreement does have a put option that can create, just as you're saying, kind of the market of liquidity, the marketability, if you will, that discount around lack of marketability. There can be that market there.
Yep. And then last question here. Can a client still give a business interest before a liquidity event, but after sale terms have been finalized?
So that's where it gets really concerning, right? That is in some ways Hoensheid, right? What we want to do is you can make that business gift, that business interest gift before while it's in the LOI series time, but before we start to get the asset purchase agreement. If we're drafting and there's already deep discussion about what are the actual terms, that is when it's dangerous. And again, we come back to that question: how cooked is the deal?
Mm-hmm.
How far into it? Sometimes that's a time thing. Hey, it was 3 weeks before. Sometimes it's a matter of days, but it's the circumstances of those days. Oh, the buyer, yeah, they had a total team. They hadn't even finished their valuation and their recommendation to their buying board by the time we made the gift, even if it was 2 weeks before a sale. Okay, well, that's pretty clearly factually not a binding event. You're making the gift before the buyer is actually at the table and before the seller is at the table as well. That's going to be the key part. We got to do it in advance of that.
Well, that's true. Well, thank you, Joel. That's terrific. folks, that's all the time we have for these questions. Like I said, Joel and I will get back to you on other questions going forward. But look, we hope that if you have future questions, I've got a list up here with Joel and I's information up here. We'll be happy to connect with you separately offline. Thank you very, very much for joining us. Joel, thanks for coming on. This has been super insightful and helpful. So thanks for coming on with me today.
Thank you, Bryce. It's been a privilege.
Take care, everybody.
Thank you so much for joining us today. If we were not able to address your question during our session, we will follow up with you individually. The recording of today's webinar will be available shortly, usually within the hour. You'll receive an email with a direct link, so keep an eye on your inbox. If you'd like to reach out with additional questions for Bryce or Joel, please scan one of the QR codes on your screen to access their contact information or email them using the email address listed. CLE certificates will be emailed no later than Friday, August 21st. We appreciate your participation and hope you found today's discussion insightful and valuable. Keep an eye on your inbox for future webinars. Thanks again and have a wonderful rest of your day.